Hi guys, I want to introduce you to one of my favorite lenders here in Solano County, Jason Russell. Hi Jason.
Hi.
Hey, Jason is a loan officer with the Neo Home Loans, and he's doing it, has been doing it for like over 18 years, if I'm not wrong.
You are right.
This is awesome. Well, I would like to talk today about the 2-1 buy down program. What does it mean?
Yeah, it's a really great program. It's a great question, first off, and it's a terrific program that right now is allowing for sellers to help subsidize the payments for our buyers. So, as many people know, right now the market is really finding some equilibrium in terms of buyers and sellers being willing to negotiate more than they have been in the past 2 years. So, one of the things that we have been doing, given that interest rates are much higher than they had been, is to help use that seller credit in a way that helps to alleviate some of the pain that comes with those higher interest rates and the payments that come with them. So I'm going to just briefly share something, just a little illustration here of what I'm talking about. So this is an example of a $500,000 loan. And if we say that the interest rate on that loan is 6.25%, and the monthly payment is $3,079, right, for the loan itself. Now, in this scenario, we get an $11,244 credit. This comes from the seller. So rather than the seller look at reducing the price of a home that's been sitting for a while, we get them to give us a credit. And what we do with that credit is we help subsidize the mortgage payment for our buyer for the first couple of years. So for example, in the first year, the buyer is paying a payment that is based off of an interest rate of 4.25%. That gives them a $2,460 monthly payment, which is a $619 savings over that $3,079 payment. And that $619 a month is pulled each month from that seller credit of $11,244. And then after the first year, we move into a payment where the payment is based off of a rate of 5.25%. So now the payment goes to $2,761, which is a $318 a month savings. And then that $318 is pulled from this account for the second year. And then after those 2 years, that seller credit is exhausted, at which point the payment just returns to the fixed payment at 6.25% of $3,079. So it's just a really, really unique way for the sellers to be able to contribute in our buyer's mortgage payment.
Okay, wow, this is awesome. So basically, yeah, the seller pay portion of their mortgage payment for the first few years. It's awesome. So it helps a lot. So hold on. So if like after 1 year, the buyer decided they want to refinance because the interest dropped less than what they pay right now.
Yeah, well, it's a great question. And it's an important one because many experts in the real estate community believe that interest rates are going to drop at some point next year. And what's really valuable about this scenario is that the money that comes from the seller, it sits in a custodial account. That money belongs to our buyer. So in the event that after 1 year, there's $4,000, for example, left in that account, that $4,000, once they refinance the home, that $4,000 is immediately applied to their loan balance. So their loan comes down by $4,000. So that money stays with our buyer and belongs to them. Whereas traditionally, if you want a lower rate, you use the what we call points to buy down that rate. And if you do that and then refinance, that money is gone, right? So you're not in the loan long enough to take advantage of it. So this is a really, really good way for folks who do believe, as many experts do, that interest rates are going to come down, to be able to take advantage of the lower payment that comes with that, while at the same time protecting your money in the event that rates do improve.
Well, okay. So basically they have this amount of money, they use it for the buy down. And if after 1 year they decide they don't want to refinance, they just use the balance and the balance go to the principal.
Yeah, which essentially pays for the refinance, right? If depending on how much money is left in there. So in a way, it allows in that scenario for the seller to have paid for that lower payment for the first year and then pays for the refinance once it's done, right? So you kind of get the best of both worlds in that scenario.
All right. Well, thank you for explaining us a little bit about it to make it more clear for my clients and my audience. And I'm looking forward to see you next time.
Awesome. Thanks for having me.
Thank you so much.